Hi, I'm Brooke Thackeray with Horizons ETFs. Thank you very much for joining me today. Today I'd like to use the Horizons Seasonal Rotation ETF, ticker symbol HAC, its weekly commentary, as a basis for this market update. So let's jump right in and take a look at the market action last week. Here we can see the S&P 500 was up 0.4%, bettering the Canadian stock market at 0.3%. The big news last week was the CPI number coming in at 5% versus an expected 4.7%, and the core number coming in at 3.8% versus an expected 3.4%. So what we saw was higher inflation being reported on Thursday, higher than expected, and yet the stock market rallied and interest rates went down. Take a look a little bit at that later on. If we take a look at the changes last week in the HAC portfolio, HAC made some minor changes, increased its position in the U.S. REIT sector and also the U.S. government bond sector. Both of these sectors have been performing well. It increased its short sell position in the materials sector and the transportation sector as well. Both of these sectors have been underperforming the U.S. stock market. If we take a look at what's taking place for the S&P 500, last week we did see the S&P 500 closed an all-time high of 4274. But what's interesting and concerning, mind you, is the volume. Look at the volume falling here. So we're not seeing strong volume as the market's been moving higher and setting an all-time high. You'd like to see strong volume to show that we have some legs to this rally. We haven't seen that yet. And also, too, the RSI has been heading lower since April, not showing that there's not a strong price momentum taking place. If we take a look at the U.S. 10-year Treasury yield last week, interestingly enough, we did see that the U.S. Treasury yield once again on the 10-year fall. So on Wednesday, it was at 1.5, excuse me. And the announcement for the CPI was announced on Thursday. And on Thursday, the U.S. 10-year Treasury yield actually closed down at 1.45. We did see that slight tick up for the yield on Friday. Overall for the week, it was down though. If we take a look at the U.S. dollar last week, so an interesting development taking place here for the U.S. dollar. It was negative on Monday, positive on Tuesday, positive on Wednesday, negative on Thursday, and look at this strong rally on Friday. Huge rally for the U.S. dollar relative to world currencies. Now, if this persists and we see a strong U.S. dollar, this could have an impact on the reflationary trade and a lot of the commodity sectors that has been taking place. If we take a look at what took place at the sector level last week, we did see here's the S&P 500 at 0.4%. Look at the growthy sectors here, the consumer discretionary sector, the communication services sector, technology sector, all positive and outperforming the S&P 500. As interest rates went down in today's environment, that could be expected, of course, but look at these cyclical sectors here. If you take a look here, look at them, industrials, materials, energy, financials, all negative last week in the U.S. market. Now, interest rates were down last week, and so these cyclical sectors can suffer in that environment. But if the reflationary trade was really strong here, we wouldn't see such weak performance from these sectors. And last week that was a quite weak performance. We'll have to see what happens this week coming up. Look at the defensive sectors. In the marketplace last week, we saw real estate once again put in a very strong week. It's been performing. This U.S. Real estate REITs have been performing extremely well. Consumer staples was negative. Can be a little bit soft sometimes over the long term, on average in June, relative to some of the other defensive sectors. Healthcare sector, look at that. Strong performance from the sector. June tends to be a strong month for the healthcare sector. On average over the long term, we saw a strong performance from the utility sector as well. Last week was interesting because we saw CPI inflation numbers coming out on Thursday that were higher than expected, and yet the stock market rallied higher and interest rates moved lower. This divergence shows that there's a conflict taking place between stock investors and bond investors. This week's also going to be interesting because we got the Federal Reserve meeting on Wednesday. Now, most investors don't expect the Federal Reserve to make an announcement that they're going to change their federal funds rate. But what's going to be interesting is the language that's being used after the meeting to describe their policy decisions in the future and investors' reaction to that meeting. So watch what happens this week to investor, to the stock market and bond market performance after the Federal Reserve meeting. That could give us some indications of the health of the stock market and bond market over the next little bit. Thank you very much for joining me today.